What a week it has been. We pretty much saw a war start, and we saw further rate cut expectations get pulled off the table. There's been a lot going on. It's been a very big week. We saw equities pull back. Definitely a different environment than what we've seen the past few weeks. So I think let's start off with, why did rate cuts get pulled off the table, and what caused this sell off in equities?
Well, I do think that the sell-off in equities that we saw earlier this week and kind of into the end of last week was war driven. But I do think that it essentially spiraled a little bit further, right? I do think we're beyond war discounts at this point. Just nor I you could almost assimilate it to like the war premium or the war discount that got priced into the market last week and the beginning of this week kind of kicked off more systematic selling. And you can just see it like every day. The market's been persistently getting pushed lower. And we're now down about, what is it, six on the Qs? We're down about 6%, almost 5.75% off the last high, which is also the last all-time high. And I do think that at the current point in time, this is actually nothing to be afraid of. I know that it might seem scary in real time, right? You're looking at this, you're like, oh my God. You look at something like the SPY, right? And this is just also down pretty stiffly from the highs. I mean, we're talking almost 5% here. And at the same time, this is not abnormal in a risk on / bull market environment. Now, not telling you, look, this is the absolute lows. I do believe that the top or the high for both the NASDAQ and the S&P, the bull market, or you can call them cycle highs, are not in quite yet. Now, can that case be wrong? Of course, I could end up being wrong. I just don't believe I will be at this point in time. There's not enough data telling me the odds of that happening are dramatically lower than where they were just a few weeks ago when we were hovering below them.
Well, yeah,
So,
especially with these rate cuts being priced off the table. What's going on with that, and why is the market kind of running with the idea that inflation is really going to continue to be a persistent issue, and the Fed needs to hold rates? I know a lot of Fed speakers have been coming out and saying, "Oh, we may not even cut this year." Why do you think they're saying that now, and what changed since just a few weeks ago?
I think it's very hard to find a specific data point that changed. One outside of obviously energy going up, like if we look at crude, right? Crude went up the last couple of weeks, and in the process, I mean, we can take a look at the implied policy gauge here that we have. 2 weeks ago it was -2 cuts. Now we're at -1.5 cuts, and 3 or 4 weeks ago it was -3 cuts. Now, to put this in perspective, the Fed's dots look like -3 cuts for this year. So this number, if this number was this orange bar here, for those that are listening, the implied policy gauge is currently indicating 1.5 cuts. That would, if it would match what the Fed is implying, it would be double that. Now, that pullback, or that I should say, that withdrawal of cut expectations, I think is on the back that the economy is resilient and oil prices are up and inflate. And obviously we saw just the general market in this whole war, this whole, I don't want to say war, this is more of a conflict, right? This Middle Eastern conflict at the moment. I think that just has inflation fears on edge. We saw swaps also grinding higher. So I think just there's a general consensus that there might be some issues with inflation going forward. Now, that doesn't mean inflation is per se hot, right, or running away from us. It just means that the market's kind of putting in an estimate that it's going to be a little bit stickier than I previously thought. But I do need to clarify that these Fed policy expectations jawbone either way. I mean, in December of 23, we were looking at 6 cuts this year. Now we're looking at 1 cut, right? So I do think that there's this wide dynamic that's going on here where the Fed has been pretty consistent in what they've been saying. I do think that if they don't actually cut at all, and if they even, I would even say if we only get one rate cut this year, that's problematic. Zero cuts is a big policy mistake. One rate cut's problematic. And a lot of people are looking at things like unemployment claims. I mean, excuse me, jobless claims in the unemployment report, and they're like, okay, jobless claims aren't really moving. Unemployment rates pretty much cemented near the lows. The Fed needs to go much higher, but you can go a little bit deeper than that, right? Like when you look at the market and you say, okay, bonds are down, aka long end has lifted in the last couple of weeks. Oil's up with that to a degree. It's pulled back the last couple of days, but again, it's been up for the most part of the year now. I don't think we'll go over this too, why this isn't too problematic just yet, but all in all, when we take a step back, when we look at something like the labor market broken down as a supply rate between the number of job openings versus the number of unemployed persons, you can see that, and we've spoken about this in prior podcasts, but those that are just listening now, you might not have any idea what this number signifies. So again, it's how many job openings exist for every person that's unemployed. So this number being over 1 indicates that there is a theoretical surplus of available jobs for every unemployed person. Now, you can argue what's the quality of these jobs? Who are these jobs available to? That's a different conversation, but I think the moral of or the message of this whole thing is that this ratio was pretty much at 2, meaning there was legitimately 2 job openings per every unemployed person at the start of 2022. So the labor market was extremely loose. And if you notice something, or again, if you're listening, I'll explain it. As soon as the Fed starts raising interest rates, they put a ceiling on this rate. The rate has not gone higher anywhere. The rate's actually gone down quite significantly since the Federal Reserve started raising their interest rates in 2022. And I think that this is a sign that if you won't, it's not something you would notice if you look on the surface. But if you take a step further and look, the labor market has been experiencing moderate weakness for quite some time now, and this is one of many indicators out there.
This is also something the Fed looks at. So I'm curious, why are some of the Fed members coming out and basically going against their dot plot and saying that they're possibly only going to cut once this year if the data is showing otherwise? The data is showing that the labor market is weakening slowly, not much, but it is weakening. Inflation remains under control. It really has not been blowing out at all. So why are they coming out and saying this?
The word's possibility, right? The possibility of no cuts. That's the key word. The key word there is possibility, because we all understand that the Fed can effectively tighten and loosen financial conditions without actually having to enact any policy change. Think about it. Between December of 2022, December of 2023 to March or April, now April of 2024, the market has removed pretty much 5 rate cuts from the forward path. The Fed has not done anything but reaffirm that they're going to cut rates 3 times this year. Except their verbiage, the way they approach things, their pessimism about inflation being under control, all these things play a role in the possibility of those dots changing. Again, keyword possibility, right? So as the market's trying to figure this out, and like as I was saying earlier, we've been jawboning up and down. We were just at -3, now we're at -1 in terms of implied rate cuts for the year. And I think that all in all, this comes back down to where inflation is actually going and what the market's going to actually realize as we progress here with rate cuts and just the progress on inflation and disinflation itself. So one good thing we can look at is crude. Now, crude is obviously an energy component. Energy is hold a decent size in the CPI basket. It's not the end all be all, but it's just a gauge, and even commodities as a whole are another good gauge to look at. Now, if we zoom out here on crude, and let's make this chart nice and crisp and clean so we can see what's going on here. If we zoom out on crude, we are currently below the 2021 high, the 2023 high, obviously the 2022 high, And we're just about where we were in August and October of 23. So crude has gone nowhere since August of 2023 and October of 2023. Now, everyone's going to say, oh my God, we're up, crude's up, what, 10% for the year? Yeah, no, well, we can take a look here. Year to date, 14%, right? For the year. Up huge. Notice the year literally starts pretty much around the stone cold lows on crude. So yeah, we're up nicely off the lows, but that's not how inflation works, right? In terms of the actual change in cost of goods. Yes, they're up decent, or quite a lot since the start of the year, but they're not really much or up much on a year-over-year basis. And if crude stays in this range, that CPI effect is going to pretty much just be recycled around. As long as crude volatility comes down, that impact on the rate of change basis going forward is going to be compressed. So when you look at something like this, obviously we have problems if crude's above the 2023 high. Then we have to start worrying. Oh, okay, inflation's really like going somewhere. It might have the breakout potential here, at least on the energy side of the inflationary perspective. But as of right now, crude is not above the 2023 highs. Broad-based commodities are not above the 2023 highs. They're a bit higher, but again, they're also just kind of going sideways, right?
Well, do you see this Israel conflict becoming an issue and affecting crude prices?
I think we spoke somewhat about this a couple of weeks ago, and I like that you brought that up because I think it's a good point to reiterate in terms of like the energy bulls out there. Like I wrote this ledger note a couple of months ago as well, and that's about a month ago, and that's on X for free under our article section on our X page. You can go there and read it, get a broad based summary of what's going on. But long story short, energy going up is something that can shift very quickly I should say commodities going up can shift very quickly to commodities not really going anywhere, while growth actually stays positive. So you can have this dynamic where you pivot between growth, positive inflation and growth to negative inflation and growth, or disinflation and growth, right? I don't want to say deflation, it's more disinflation. And in that environment, commodities stop working, but the growth plays still do. And I think there's some dynamics here that we have to understand. Disinflation is not dead just yet. The Fed is restrictive. We can argue the Fed is not restrictive, but they're obviously restrictive in terms of what's going on with real interest rates at pretty much the highest they've been since 2008, right? Especially on a 1 year basis. And then we have the labor market obviously weakening. And then we have things like commodities that are pretty much under control. They're not really accelerating. So the Fed is in a restrictive stance. Okay. Now, on top of that, you also have an administration that wants to keep their seat into the next election. Now, we can play all the conspiracy games we want, but it's pretty simple. There's already verbiage floating around just this week that they're gonna look to dump. They're ready to dump supply from the SPR into the market to keep gas prices down for the heightened summer driving season, what they're calling it. So basically what you're doing when you're long energy here is you're betting the Fed has lost control specifically at this point. Maybe at the beginning of the year there was a counter trend move to be had there, but obviously us at Market Radar, we zoom everything out. We like to take the more macro broad-based approach, something that's going to be more secular than just a 2-3 week trade. So in terms of like the longevity of this oil trade, the Fed would have to end up not being restrictive, and the SPR releases would have to end up not being effective. Now, if you notice something, as soon as oil was falling, as soon as the current administration was indicating that they were going to start adding to the SPR, I think it was at below, was it $70 a barrel? Something like that? It was anything below 70?
Yeah, somewhere around there.
Somewhere around there, right? Oil stopped going down. And I think the SPR added about 1 million barrels a month for the last 10 months in the process. Okay? And now I wouldn't be surprised, but don't hold me to it, that this high may hold here on oil on just the anticipation that, look, if oil starts really, I don't know if they really dumped anything yet. We'll have to see in the next SPR update. But in terms of, especially over the last 2 days, But in terms of oil going higher, maybe Biden just put a sentiment ceiling in the Biden administration without actually having to dump much oil yet. We'll see. But all in all, again, take a step back. The trend's bullish, right? So again, I wouldn't be surprised if this is the top, but if we do go higher, the trend's bullish. So we obviously don't short any energy, but I wouldn't be surprised if the upward price action is somewhat muted now going forward. And then I know you said something about the war, and I want to get to that with in terms of energy prices. I don't think the war is going to be that much of an issue for energy prices. I mean, when we saw the conflict really floating around on Monday, right? Um, like we were getting the Friday, we had that Friday spike on crude. Let's take the contract adjustments for futures off. We saw it go up to like 87 barrel, almost 88. And then Monday we had some issues going on. And obviously the conflict is still ongoing, right? But this type of roll off, you would have expected to see like more of a ramp, and which makes me think some of this move going up into it, maybe the last week of March, this type of action, this was them, the oil markets at least trying to get a good pricing or good attempt to price in this type of conflict. I wouldn't be surprised if that has been the case. We'll have to see though. You can't really price in conflicts like this depending on the exponential effects or ripple effects that come off of it. We don't really know. I don't think it's as dramatic as the Ukraine conflict, obviously. And even then, a lot of people, especially energy bros, they really love these types of. I don't want to say they love the conflicts, but it supports their thesis, so they're all over it. And they're really just out here pointing towards this move in 2022 because of Ukraine, because of the Russia-Ukraine conflict / war. And I think that it's a very different time because we were already in a commodity super cycle when that happened.
Yeah,
right?
I think
So
what's really been happening lately is we had disinflation and the market was running with that. It loved it. And now I think in the past couple of weeks here, disinflation took a bit of a pause. And I think the market is seeing that and running with it and kind of taking that as more of a reason for the Fed to hold rates longer or maybe even possibly raise rates. We're not there yet. I don't think we will get there, but that's really what it feels like is happening here. So like disinflation kind of took a bit of a pause here, and that's why we're seeing Fed cuts being taken off the table. But that's also going against what the Fed has been saying they're going to do. And it kind of reminds me of the exact situation we saw going into the hiking cycle, where every step of the way the Fed was saying we're going to raise rates, and the market kept underpricing that. The Fed funds futures were pricing in, first they were pricing in a peak at 3%, then 3.5%, then 4%, and the Fed just kept saying we're going to keep going, but the market just didn't believe them. And now it feels like we're on the opposite end of that, where the Fed is coming out and saying we're going to cut rates, we're going to cut 3 times this year, and the market is now running with the idea that they're not going to cut at all and kind of mispricing it there. Do you think that's something that is happening right now and the market's going to be wrong again on this?
you know what it is? I think it's much easier to say um the market will be right or wrong once the cycle has started, because we know how systematic the Fed, I shouldn't say how much pattern recognition the Fed has, right, in terms of doing things in repetition. So like if we were in a rate cutting cycle and the market started pricing in a pause, I think that's where we could have the debate. But I think that, look, I believe the Fed should cut rates 3 times this year. I think that there's merit to do it. I think the Fed should have already started this 3-cut cycle already. We should have seen at least a rate cut and just get the ball rolling. But they want to do cut, cut, cut. They don't want to do a cut, a pause, a pause, a pause, a cut. They want that that system style type of environment where they're just gradually reducing rates. And I think that we could end up seeing one rate cut. It would be a policy mistake. But then to sit here and for you and I to argue about that on where I shouldn't want to say argue, but debate if we're going to get 1 to 3 cuts, you're really just saying, look, is the Fed going to fumble the ball here? And I can't say they won't. because they've obviously done this before. They now are. What happens if we're looking at a similar environment to what we were in 2021, where inflation going up was just transitory? It'll come back down. The Fed was locked on the floor at zero, nothing. Then all of a sudden they start lifting. Now the Fed has lifted and locked up at 5.25. Now, do they wait too long to start dropping? And that's where the compound landing comes in. That's the stage 4. Stage 3 is this normalization phase where the economy kind of chugs along and everything goes as planned. The soft landing's taking root. But if the Fed doesn't actually start cutting rates, which is what the market's been implying, which is what the Fed has been implying based on the growth that we've been seeing, etc., then they're going to blow their shot at the soft landing, and then we're just going to be faced with the hard landing, which is stage 4. We've been saying this for pretty much 6 months now, at least almost 8 months. The hard landing is avoidable to a degree. They can land this whole thing softly, and now the arguments, there's no landing. No. There is a soft or there's a hard landing. There is no such thing as no landing. Study economic cycles. The lessons are in there. Okay? The soft landing is only achievable if the Fed reduces policy as inflation comes in. If they don't, what ends up happening is that differential of restrictiveness starts blowing out, and the Fed just actually grows in restrictiveness as the market cools or the economy cools down. If they don't bring rates down, what ends up happening is that soft landing window collapses, and you end up just in a situation where you have an over-restrictive Fed that hand-in-hand fuels the hard landing. Now, I want to finish this podcast off with something that's quite interesting. And this goes back to my seasonality brothers. Okay, all these people that were claiming all year long, windows of weakness, 80s of March, whatever nonsense they were, right? All this nonsense. The March was supposed to be a weak month. It was a strong month. April was supposed to be a strong month. It's a weak month. What if we say, instead of sell in May and go away, buy in May and go away? That's the next stage of this seasonality cycle. May is supposed to be the weak month. And this is complete, utter nonsense, what I'm spewing right now. I am just saying the seasonality bros have got every stage of this run-up wrong to the point where, like, it would be comical if it's no longer sell in May and go away. It becomes buy in May and go away. And I think that's where we can wrap up this podcast. And obviously, that all is dependent on the system, which we have in our quant deck, refreshed on a daily basis, dropped in our Discord and on our website at market-radar.com. If you guys are interested, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com.